This business makes $1.5 million a year and they're asking $5.7 million for it. I'll show you why the deal is really worth only $5.3 million. And if you're a real operator, I'll show you the path to grow to $7 million in 24 months. This is Business Valuation Day 60. I'm Eli, and I help business owners avoid big, expensive mistakes for buying, scaling, or selling a business by doing business valuations and exit planning. Let's break this business down. This is a B2B commercial flooring in New York City. They're doing $16 million in revenue and about $1.5 million in EBITDA, and the asking price is $5.7 million. At first glance, the multiple looks fine, but what really decides the deal is not the multiple. This is a project business, not a recurring type of business. Cash flow depends heavily on backlog, on execution, and getting paid in time. Miss any of those three and the margin slips. They say that there's a $20 million backlog, which is important. That backlog isn't value on itself. It really counts only if the job are priced right and managed well. Then there's the working capital part. Inventory and receivables are built into the price, which means that the cash is always moving. And most buyers and investors will underestimate how much attention this needs. The good sign here is the structure. The listing says there's a management in place, there's systems in place, and that the leadership is willing to stay for 3 to 5 years, which is very rare at this size of businesses. So this isn't a passive business, but it's institutional grade. If I want to take this $5.7 million business and make it a $7 million business in about 24 months, here are the 3 things that I would do. First, prove that the backlog is real. This $20 million sounds great, but buyers and investors will ask how real is it? I would have to show what's signed, what's awarded, and what's pending. I would want to see the data. I would want to see the margins per job type. I would want to see the pricing for these deals and how forecasts compare what actually happened in the past. Because when the backlog feels like future cash, like kind of like predictable cash, the buyers and investors will feel much more comfortable to pay top dollar for a business. Second, you have to build a systemized, process-driven sales process. Make sure the sales doesn't rely on few people, because most buyers will ask who actually brings in the work. If the owner brings in the work, if the owner is the moneymaker, this deal would get discounted super fast. You have to make sure that the deals and the money doesn't rely on few names. The third thing that I would do is I would empower the management and I would make sure that they take care of their lane. Track their performance. Make sure your managers take care of the operations as a whole. Make sure you have an operational playbook that makes sure that everything works in a repeatable, systemized, process-driven way based on your standards as the owner. Because when the execution feels predictable and safe, buyers are much more likely to pay top dollar for a business. Bottom line, we don't need more contracts, we don't need more growth, we don't even need more revenue. We need less key person risk, we need trusted backlog, and we need data. That's how this deal becomes a $7 million business. This business is for strategic buyers, larger contractors, private equity companies that are doing roll-ups. This is not for a first-time buyer. Buyer needs to finance with the SBA. And if you want clarity and confidence about a business decision you're about to make about buying, selling, or scaling a business, I do private breakdowns and one-on-one strategy calls. Links in the bio. And comment the next business you want me to analyze.